Welcome to TheoTrade. This is Don Kaufman. It's November 8th, 2017. Tonight, we still have about an hour to go into the cash close. We're going to look at something vastly different than we typically do here at TheoTrade. A lot of emails lately have really sparked a lot of conversation regarding valuations of the current marketplace and of individual stocks. And I think there's a tremendous amount of argument going on back and forth. I mean, can companies like Microsoft's, your Apples, your Facebooks, your Googles, your Amazon, can they really, sustain the valuations, and really are they worth that? And I'm going to give you a vastly different look, much outside this argument of valuation. And we're even going to talk a little bit tonight about quantitative funds that are really driving much of the trade. So without further ado, let's kind of get into this to describe what is going on in current markets. All right, I'm going to go ahead and close up this left sidebar, and we're going to start here with the QQQ. Now, I've set up a style prior to this, and we're going to go into load style, explain it as I do load it over here. We're going to look at a comparison chart between the QQQ, the spiders, and the IWM. Now go ahead and click on that. Now, whenever I do a comparison chart, and I'll mark a few things up here on the screen to orient everybody with what you happen to be looking at. When you're doing a comparison chart, comparison charts, initially this is going to be on a year to date, so it's a year to date. Everything is going to be done in percentage terms. Now, specifically, what you happen to be looking at is on the top of the screen happens to be the Qs. The middle of the screen are the spiders, right? Representative of the S&P. Qs, of course, the Nasdaq. And on the bottom of the screen, IWM, which is better known as the Russell. And lately, again, there's this argument about individual stocks and, what their values really are worth. And it's just really kind of kicking off like this last 4 or 5 weeks. Sure, people constantly talk about valuations of the marketplace and is this sustainable? As I said, I'm going to give you a vastly different look. Okay. At this point, it's my thesis that it's really quantitative funds that are driving much of the market moves that we see, not only on a day-to-day basis, but over the last couple of years. And I'll describe to you what that means. A quantitative fund, one of the first things that we have to kind of grasp about this idea is that most quantitative funds are not trading per se on, are we bullish or are we bearish? Okay, so for just a second, we got to get that idea of being bullish or bearish out of our heads. A lot of these quantitative funds are algo driven, right? The computerized trading, and what they're doing, okay, put everything you aside regarding classical finance. Everybody's okay, the market's going to go up, the market's going to go down. Yeah, well, what if there are funds out there right now that just drive trading based on making fractions of a penny and doing it tens of millions of times in a day? And I'll just throw that out to you to begin with. And moreover, what if these firms are capable of borrowing money for next to nothing in different types of carry trades? Let's not forget for a second, okay, that there are many sovereignties, including, for instance, Japan, that is still in a negative interest rate environment. So bear with me with that notion for just a second. A negative interest rate environment, right? They're paying you to take money from them. So trading firms, okay, could be over in Japan, could be US firms, could be banking institutions, are literally carrying trades and carrying capital from Japan, which could show right back up here in the US. You've got the same thing going on in Europe. For the most part, what you want to think about is cheap capital. And any way you want to put it, when capital is dirt cheap, all right, the cost of capital is absolutely dirt cheap. Some way, shape, or form, that capital is going to find its way into the markets. One of the ways, okay, that I have kind of summarized, and I'm going to summarize here momentarily for you, is that whatever happens, however that capital finds its way into the markets, it's still, okay, extraordinarily bullish for the marketplace. However, many of these quantitative firms, to produce alpha, that's to produce returns, okay? For this part, let's go look at an individual stock like something like Microsoft. To produce returns in Microsoft, what do? They drive capital into Microsoft. They drive capital into stocks like Apple. okay? And many of them have actually figured out, and this is a horrific term I'm about to use, but many of these firms have figured out how to kind of game the system. And by gaming the system, they figured out if they can actually drive capital into 5 or 6, okay, key components of the marketplace, they can not only shift the Nasdaq futures, but they can also shift the S&P futures. Now, allow me to show you this on a much broader take. What you're looking at here is kind of a conglomerate symbol, okay? This happens to be Facebook, okay, plus Apple, plus Microsoft, plus Google, plus Amazon. And in this particular symbol, you'll see it's like 5.8 times Facebook and 6.4 times, Apple. And, what is that? Well, I took the price of 1,000 and kind of divided each one of the stocks into 1,000, right? So Google and Amazon were right around 1,000 at the time of me constructing this conglomerate symbol. So bear with me here. So I'm going to take this symbol and I'm going to hit Control C, and I just copied that symbol. You're like, okay, so why are you going to copy the symbol? Wait for it. So we're going to go back to the Qs. We're going to drop back to my original style over here. Okay, and again, there's a little bit of work and a little bit of thought behind what I'm doing. So once again, we're back to this comparison that we started with. The Nasdaq is just smoking through, okay, ultimately the S&Ps, and last but not least, the Russell. But in addition to this, we're going to come up to studies. We're going to go add study. Okay, so here's study. Okay, we're going to add study. We're going to go compare with, and we're going to go custom symbol. Now, to paste something in here, now we're going to hit Control V. And it just pasted our, kind of conglomerate. I call this the Monsters of Tech symbol, right? So we'll just paste the Monsters of Tech into this comparison. So yeah, ladies and gentlemen, now we got a four-way comparison. Up here is the Monsters of Tech, followed by the Nasdaq. You have to look at this for what it really is. And what's that? These 5 underlyings have driven all the returns, not only of just the Nasdaq, but they've also driven the returns of the S&P. Clearly, the Russell product doesn't have too many techs in it. In fact, the Russell happens to be heavily weighted into financials, which I'll come here in just a moment. You can literally account this last shot to the upside, okay? And I'll get into very, very specific over here. You can account this entire last shot to the upside, specifically in the Nasdaq, and that move occurred right here during some of the earnings, okay? That entire move up in the Nasdaq is predicated literally on those 5 underlyings. Sure, there's a few other, outliers over there. I mean, people are pointing out, well, what about NVIDIA? What about Intel? Yeah, but if you're trying to game the system over here as a quantitative fund, you're going to push as much capital as you possibly can into 5 underlyings to drive the index behind that. Now, what we've got over here is you're like, okay, so firms are buying many of the tech stocks. Newsflash, Don! I already knew that, okay? They're doing a lot more than that. They're not just buying the tech. They're using a bunch of different hedging methodologies, okay, in the backdrop behind this. Okay, the game right now is buy tech at any cost, and it's ultimately driving those underlyings up. And they're just seeking some alpha out there, just trying to drive returns in any way, shape, or form. But at the exact same time, they're shorting anything, okay, with the name retail involved in it. Now, in terms of retailers, sure, I could point out some like marquee disasters. Like, let me go over to something like Bed Bath & Beyond. On a year-to-date percentage return, it's down 52%. Okay, but Bed Bath & Beyond, you might construe that as a little bit of a disaster. All right, so let's look elsewhere other than Bed Bath & Beyond. Under Armour, which has been thought of as like a darling stock, that thing is down 57% year to date. Now, you thought like Bed Bath & Beyond was kind of the disaster until, of course, you looked over at Under Armour. You're like, but I see their stuff everywhere over here. Okay, what else has the name on there? Sure, you can look at another disaster. Macy's is down about 50%. But it's amazing to compare Macy's and Under Armour. You've got quantitative funds, okay, that are actually shorting these underlyings, turning around and buying a lot of the tech stocks. And that's one of the largest divergences that we currently see. And again, I can go through underlying after underlying. You can even start to get to some of the discounters out there in terms of like Kohl's, it's down 18%. Wait, I'm not done over here. Ross Stores, another discounter. Here's the winner out of the group. The winner's only down about 2.5% year to date. Okay, and we can go even further. Like, you know, if you really want to get ugly, you can start pulling up the JC Penney's, which are down 70%. And yet people aren't looking at the impact. They're saying, well, this is Amazon, Don. It's Amazon that's killing these guys. Really, if that's true, how come the real estate companies that are actually holding the properties behind the JC Penney's, you realize the JC Penney's, okay, the Macy's out there, right? Many of these are anchor stores and huge leases, yet the real estate, okay, trusts that are holding those, they're not impeded. Those things, in fact, are even going through the roof. So it's an interesting argument to make because people are constantly talking about valuation. I mean, they look at a company like Tesla and try to like support an argument behind it. Listen, as long right now as it belongs somewhere near the Silicon Valley or California, you're a winner, okay? And when this trade unwinds, you're going to have to look back to some of these retailers because this is the divergence, okay? The entire name of the game right now has nothing to do with valuation, okay? And my last point on here would have to be the financials, okay? And when I say there's nothing to do with valuation, you just can't make too many valuation arguments in a like zero interest rate environment. It's, for the most part, there is no price discovery. And why do I bring up the financials to come on kind of my final point over here? If you look again, what drove markets higher, all right? If you look what drove markets higher in the most recent kind of uptrend over here, we'll come back over to the Qs. So here's the original chart that we started with. You have to realize even the S&Ps are being influenced, but the S&Ps, their second largest sector, happens to be none other than what? The financials. So bear with me here for just a moment as I come in here and I go add study, all right, compare with, we'll throw a custom symbol. Why don't we throw the financials in here? Because what you'll see is the financials diverge substantially lower. That's the second largest sector in there. Again, this is about gaming the system. This is about quantitative funds figuring out that they have an edge, okay, so long as they keep pumping capital into these technology stocks. Now, yes, eventually this will unwind, okay, but I want to remind you, these quantitative funds are using algorithms and they're going to be on the forefront of the down move as well. And when you see stuff like this, okay, this isn't an argument about this time is different. Yeah, this time is different. This time, you've got 5 underlyings that have no valuation metric whatsoever, and you've got these quantitative funds just dumping capital in there, okay? This time is never different, okay? This time is quite the same as many other, and I hate to use that term bubble because I don't think per se this is a bubble. We've gone well beyond that. This is trading firms running amok inside of a marketplace that, again, it's next to impossible to value assets over there. My last point with this, is again, the financials, which have come off substantially inside of the last 2 trading days. Okay, you have to realize the financials lately, they've been propped up simply by the fact that the S&Ps have been tracking higher. If the S&Ps are tracking higher, we can't possibly let the financials go down. But people don't recognize that in just the last couple of trading sessions, if you go look over at the TNX, interest rates are going down. You've got interest rates going down. That is big headwinds for some of the financials. Again, a lot to think about in this kind of particular evening segment over here, but I really wanted to, stop some of the arguments behind, if you will, what happens to be good valuation, bad valuation. Look at it for what it is. There really are 5 underlyings right now, the driving force behind it. And the driving force behind those 5 underlyings has nothing to do with valuation, everything to do with quantitative funds, okay, that are actually generating alpha by buying those 5 and shorting many of the retailers. Thanks everybody for joining us at TheoTrade. Have a wonderful evening. Bye-bye.